Hello, everyone. Good afternoon. My name is Swadesh Rath, and I'm Ahmedabad, and I'm pursuing my 2-year MBA, and I'm in my final year.
Hello, everyone.
Uh,
Great to be here. I'm Aditya Dukre. I'm also pursuing my MBA from Indian Institute of Management, London.
Good afternoon, everyone. Tejaswini V here. Nice to see all of you online. I am also pursuing my MBA in Indian Institute of Management, Ahmedabad.
Uh, Hello everyone, I'm Nabindu Saha here, and thank you so much for the opportunity. And I too am like the others. I'm pursuing my MBA from IIM Ahmedabad in my second year.
Amazing. Well, if you guys could kick off the presentation, you have 10 minutes and go ahead.
All right. Thank you for that. Good afternoon again, everyone. We are Vanadium partners, and today we bring a strategy that turns nature from risk into return, redefining finance for a regenerative future. The Borealis Wealth Fund stands at a turning point as natural capital declines faster than finance can restore it. Traditional ESG models focus mostly on compliance, whereas our objective is measurable ecological recovery. Above this, Finland's nature linked exports make its economy vulnerable to biodiversity loss as well as systemic financial risk. Therefore, our strategy strengthens ecosystem resilience and long term returns through strong governance, clear KPIs, and capital reallocation towards biodiversity aligned assets.
To solve this a complex challenge of meeting a dual mandate, we propose a strategic 10-year balanced roadmap. This isn't a simple one-time portfolio switch. It's a phased evolution designed to manage risk, build expertise, and deploy capital to its lasting impact. Our strategy is built on three distinct phases: align, accelerate, and anchor. The first 3 years are dedicated to re-establishing the fund's foundation. The immediate priority would be to leverage the liquidity of the fund's existing holdings. We will rebalance the public equity holdings and redirect them into two distinct buckets. The global bucket, where we would transition our funds towards biodiversity screened index tracking ETFs, and the domestic bucket, where we will invest in high impact Finnish companies in nature positive sector like green packaging, and biomaterials. Here, we will also begin to pursue active stewardship to drive innovation. We prioritize domestic investment because, unlike carbon emissions that have a global impact, biodiversity is often localized. Critically, we will avoid a forced divestment of 1.5 billion euro legacy Timberland portfolio because of two reasons. One, a fire sale would lock in losses due to liquidity and transaction costs. And two, it would eventually lead to leakages or of biodiversity loss. Instead, we will hold these illiquid assets and begin the gradual process of transitioning them towards certified sustainable timberlands, such as those meeting FSC and PEFC standards. Operationally, we'll partner with specialized external asset managers. These higher near term costs are a necessary investment to access world class expertise and enable the crucial knowledge transfer that will form the basis of our in house team in the future. Once the foundation is set, we move to phase two, accelerate. This is where we scale our domestic impact. We will actively channel our new capital to transition the legacy monoculture forestry holdings into sustainable forestry assets. More importantly, we introduce a new high impact asset class, peatland restoration. While the cash flows are traditionally limited, these activities deliver exceptional environmental additionality that would not happen otherwise. This focus on true biodiversity impact also means we'll maintain a marginal underweight to some renewable infrastructure assets, which, despite low carbon footprint, can have potential negative biodiversity impacts. Operationally, our model evolves. We will build a specialized in-house biodiversity team based on knowledge transfer from phase one, reducing our dependence on external managers and improving cost efficiency. Finally, with phase three, we complete our 10-year journey. This is the consolidated end state where we emphasize biodiversity investing. Our capital focus shifts to overweighting high impact equities, particularly Nordic companies that are now integrating biodiversity into their KPIs, and real assets like timberland and peatland. Operationally, BWF's fully developed in-house team would manage assets directly, significantly lowering operational costs. This in-house expertise becomes a strategic asset, allowing BWF to form partnerships with Nordic and EU institutions to co-invest and establish best practices.
So let's look into our portfolio design approach. Our asset selection criteria is based on four key factors. First, balanced performance, where we target assets with compelling risk-adjusted returns. Second, Measured ecological impact, where we back assets with a clear biodiversity tilt that advances our net zero goals, allowing BWF to fulfill its dual mandate. Third, diversification. We spread exposure across geographies, sectors, and asset classes to reduce concentration and correlation risk. And finally, direct finish impact. As biodiversity is often localized, we allocate part of our funds to finish on the ground investments to drive measurably biodiversity improvements. Based on this asset selection criteria, we have selected the assets for the fund's investment. Next, we ran a Markowitz mean variance optimization using historical returns, volatilities, and covariances for our selected assets to derive target weights. We applied the following constraints on our Markowitz optimization. First, we keep 7.5% of the final portfolio in cash for maintaining liquidity and flexibility for tactical asset allocation and for hedging purposes. Second, we apply hard constraints on biodiversity impact and GHG intensity metrics. And finally, we put constraints on maximum and minimum weights per asset class to prevent concentration risk. Our optimal portfolio has a Sharpe ratio of 0.71 and provides an annualized return of 8.1% with a volatility of 7.2%. Next. Yeah, so the pie charts you see here shows the asset allocation of our fund at the end of each phase of our strategy. Phase by phase, we can see that the green shaded region in the pie charts are expanding. That means that capital is tilting further into biodiversity aligned finish investments, and this disciplined ramp up sustains diversification and allows BWF to reach its biodiversity goals. Finally, we also measured the ecological impact of our investments across two dimensions. First, biodiversity improvement, and second, net zero alignment. And the graph here, you can see that our fund crosses into net positive biodiversity impact by the 7th year and also achieves net zero carbon emissions by the 8th year, validating the effectiveness of our strategy. Our phased reallocation doesn't just look green, it delivers measurable outcomes as well. By year 10, every 1 million euro invested is expected to sequester 14.1 tons of carbon dioxide and prevent 0.251 PDF meter square year of biodiversity loss.
The primary uncertainty influencing BW's performance was the timing and intensity of EU biodiversity regulations. Timberland assets, while high yielding, face a material risk of becoming stranded if the enforcement accelerates. Vanadium partners evaluated three rebalancing approaches: early, delayed, and a three-phase transition. In the Monte Carlo simulation, the three-phase strategy delivered the most balanced outcome, demonstrating steady returns with strong tail risk protection. Beyond regulation timing, Vanadium partners also modeled a broad range of shocks to quantify compounding impacts on the portfolio. Volatility in asset returns, export disruptions reducing forestry revenues, short-term yield compression in sustainable forestry assets, and carbon credit costs if the net zero mandate is not achieved. The simulation showed that the phased approach absorbed multiple compounding shocks effectively, maintaining return stability even as multiple risks converged. Vanadium Partners' three-phase strategy balances five structural trade-offs. It aligns net zero and biodiversity goals through incorporating biodiversity and GHG metrics. It maintains yields while improving forest health via certified forestry. It anchors Finnish impact with global diversification to manage risk. It synchronizes cash flow with evolving EU regulation through phase transitions. And finally, it strengthens biodiversity credibility by prioritizing direct peatland restoration over carbon offsets.
Our three-phase roadmap is not only visionary but also feasible. We avoid forced divestment by maintaining liquidity and channeling capital into biodiversity green equities as well as green bonds. Real estate rebalancing is phased, starting with expert external managers and evolving into in-house BWF impact desk to internalize expertise and ensure long-term strength. Impact measurement is also grounded in standardized global metrics, which ensures credibility and comparability. Finally, through prudent cash reserves, the fund hedges effects and commodity risks while preserving agility for new opportunities. Each pillar here makes the strategy practical, resilient, and truly implementation ready. Our risk matrix identified and mitigated three key challenges, that is market risk, which is tackled through broad diversification and liquidity reserve, regulatory risk, which is managed through phased rebalancing, and impact measurement, measurement risk, which is the most persistent, which is mitigated through conservative assumptions, triangulated biodiversity metrics with multiple sources. While our model and our strategy is very robust, we also understand that it has its own limitations, such as short-term policy uncertainty, active stewardship, may face domestic shareholder resistance, dependence on external partners, and the fact that nature itself is very unpredictable, so it has its inherent lag effects. However, our strategy ensures that the fund remains responsive to these uncertainties. To conclude, our proposed strategy empowers BWF to achieve its dual mandate with expected returns and net zero carbon while ensuring positive biodiversity impact by 2035. It is resilient under stress, feasible to implement even in the face of uncertainties by rebalancing, ease of operations, and active measurement of impact. With this, we don't just preserve nature, we make it profitable to protect and restore nature. Thank you for your time and attention. We welcome your questions now and look forward to your thoughts on our strategy. Thank you.
Amazing. Thank you so much. Do we have any questions from the panel? Thanks, Stefan Genoa.
Thank you so much. Very clear presentation and thorough analysis. So maybe into your conclusion, I'm going to go right into the end. But if you could walk us through your expected return of 8.1, where I think you presented your asset allocation in terms of phases, but walk us through your modeling for that, please.
So firstly, we performed Markowitz mean variance optimization. So for computing the Sharpe ratio, we considered the risk-free rate of finished bonds, which stood at 9.96 according to the yield curve. Then our assumptions were based on S&P Global Index and MSCI indices. From these we calculated the returns and volatility, and then through with the help of this we computed correlations between each class of assets. Now using these returns were our input to the Markowitz mean variance optimization, and through this we obtained the end state of our portfolio. Our end state of our portfolio being this. As you can see, the transition from the initial state to the final state in 2035.
And maybe just a follow-up question on your cash allocation. Why do you feel you need to keep the 7.5 cash allocation? I understand the liquidity piece, but you could get liquidity from other asset class also. So why do you prefer to keep that in cash?
So I would like to take the first part of the question. So, we thought that we need to hold some amount of like 7.5% of our entire fund for allocation towards cash. So there were various strategic reasons for that. One of them is obviously we need to have like commodity hedging and currency hedging, because our portfolio is not only invested in Finland but also in various different geographies. Secondly, since we are dealing with Timberland primarily through our real assets, we also need to look at commodity hedging. And finally, we are also we need to hold cash strategically, because a lot of the assets are of high ticket prices, and if we want to make tactical allocations or tactical investments through our fund based on various opportunities that prop up, we need to have cash on hand so that we can invest in those assets. Otherwise, a lot of the fund's portfolio is towards illiquid assets. So if we liquidate them, that would lead to a loss of valuation of the fund. And my teammate would walk you through some the commodity and the currency hedging part of the cash.
Thank you.
Thank you for the proposal. I particularly like the fact that you've modeled your portfolio through 3 different stages. And on that, I'd like to hear you a bit more on the Markowitz optimization that we see on the right side of slide, portfolio design. Perhaps I'd like to hear you on how you think through leverage and the use of derivatives, but also alternative sources of funding to move on the capital market line as well. Oh, did you guys hear the question?
Hello, sorry.
Yeah, I think you guys cut it off.
I think we had I think university level internet outage.
Oh, no worries. These things happen.
I'm really sorry.
So I'll start from the start. Great. Thanks for your proposal.
Can you just hold for a few minutes. I think my other
Yeah, absolutely.
teammates have not joined yet, so that we can also present the screen. I'm really sorry for this technical issue.
No worries. Do you want me to repeat the question?
Yeah, you can repeat the question.
Yes.
Thank you. So I was referring to the slide portfolio design and the way you did your Markowitz optimization. I see your portfolio allocation that you've shown when my peer asked you a question. I'd like to hear you more about how you think through leverage and how funding strategies could be used to move on the capital market line.
Sorry, can you repeat the last part of the question? How we can use leverage and?
How do you think about leverage and potentially using sources of funding to be able to move on the capital market line on your Markowitz optimization? So essentially, how does leverage could be implemented in a portfolio such as this one, or as you decided not to use leverage, provide some thoughts around that.
So as we have mentioned in our Markowitz mean variance optimization, can you go to slide number 4, Abhindu? Yeah. So as you can see, we have focused on a long only portfolio, and we preferred a full equity investment. And we decided not to go for any external funding. Obviously, with external funding, we could have amplified our returns, but that could have also amplified the negative side as well. The idea is that we are going to get steady cash returns from our assets, and also there is going to be, if I'm not wrong, there is going to be influx of capital from the Finland government towards our fund. So we thought that there is not going to be a liquidity constraint moving forward, and we also didn't want to take a risk because there are a lot of looming EU regulation and other risk which can affect our fund. So we decided not to take any leverage, and we went a long only portfolio.
I had 2 questions with respect to ability to implement your portfolio. So in your asset allocation that you're presenting on portfolio design asset allocation, you're moving from 5% in sovereign bonds to 10%. These you have modeled based on 2 specific indices, one that's a home base and one that is the Africa sovereign bond index. Yeah. Do you project being able to put that much money to work in these geographies to start? And second, how do you consider this is one of the part of your portfolio that you are projecting to be the less volatile? Do you consider that you are sufficiently diversified geographically in your bond portfolio?
Okay. So from the first question, we were able to find a lot of biodiversity linked bonds from Africa and obviously a lot of sovereign bonds from Nordic countries. So we could not find particularly Finland based sustainability linked bonds, but we were able to find Nordic bonds issued by various Nordic countries. The idea is that we wanted to allocate a lot of our bonds portfolio towards Nordic countries because biodiversity is much more of a localized phenomena, unlike GHG emission, which I have mentioned. So GHG emission, even if it happens in any part of the world, it's going to affect globally, while we need to have impact investments inside the geography of Finland. That is why we had a lot of allocation towards Nordic or Finland and surrounding countries. And second, we were able to find a lot of sustainability linked bonds in Africa. The second question, which is your geographical diversity, yes, this is allocated more towards Nordic and Africa, but as you can see from our asset allocation, we were able to sufficiently diversify across the globe. Obviously, you can see a lot of impact investment in Finland because, as I've mentioned, biodiversity has to be localized. That is why we have to make impact investments inside the country of Finland and also surrounding countries. So, as you can see, we have allocated sufficiently to various countries globally. But yes, the bonds providing the low volatility, we thought of having a lot of its investment towards Finland, as you mentioned, because of the low volatility.
And what is the size of these markets versus the money you have to allocate to them?
So we are not aware of those numbers right now. But if I'm not wrong, recently Gabon issued a lot of blue bonds, which were of high value, obviously a lot of value. So I think there is enough bonds available for our fund to invest in. And as you can see, there is South Africa, Gabon, and other African countries, and also sovereign bonds by as countries in our neighborhood. So the idea is that as we're moving towards a focus on biodiversity with a looming EU regulation, we believe that all the countries would also focus on biodiversity moving forward. That's why even if we are not able to find sustainable linked bonds, we would focus on any sovereign bond issued by these governments. Again, that's an assumption, and that's one of the limitations that we have mentioned in our strategy.
Thank you.
Christoph?
Maybe one question that's a similar topic, but on the equity asset class. Can you maybe talk about what is the agnostic investor benchmark, you would say, for a global equities portfolio, and how you made choices, as in on the proxies you're using and the markets you want to invest?
So, so for the international bracket of the public equity sleeve, so we took a very few indices such as the S&P Large Mid Cap Biodiversity Index and S&P Core Eurozone 50 Paris Aligned Transition ESG Index. So the S&P Large Mid Cap Index was again a global index, but a lot of focus towards North America, and as we know, with the current scenario of how North America's stance is on ESG and other related factors, we also wanted to diversify into other types of equities. That's why we also held some allocation to specifically Eurozone 50 Paris Aligned Transition ESG Index, which has a lot of its asset investments in Europe. So that is how we decided on the international equity portfolio. For the domestic portfolio, can you please go to the domestic sleeve? So for the domestic sleeve, we determined biodiversity aligned industries and determined listed companies in those industries. So the primary focus was biodiversity positive national champions in innovative environmental technologies, the size of the company and possible active stewardship role that we can take. Again, this is also one of the possible limitations of our strategy, that an active stewardship position might not be possible moving forward due to backlash from existing shareholders, because that might be perceived by them that this is not the proper strategy moving forward for financial returns. But with information transfer and by educating them, we believe that possible active stewardship can be maintained, and obviously risk-adjusted returns. So these are some of the companies that we looked at for the public equity sleeve. So combining these two, we had our entire equity portfolio. The idea of having a public equity sleeve is that we wanted to have direct impact in Finland, and not only from timberland, but also other parts of the supply chain. So for instance, down the supply chain, this was also diversify a lot of the risk related to commodities.
Maybe one follow-up on the international side.
Yes.
Can you talk to sector composition? Like, as in, like an example would be in our seat is, do we have exposure to, for example, US tech is a big theme, right? Like, how do you interpret that looking at your proxies?
So, I can talk a bit about this. So, the large mid-cap biodiversity index, which we are investing in, has a considerable amount of its investment in the tech sector, particularly in companies like Nvidia, Apple, and it has a heavy bias for US, so it generally has a lot of investment in the US tech companies because of like them them not having as much negative impact on biodiversity as like other sectors.
Do you have a follow-up to that, Leslie?
How sensitive is your proposed asset allocation to your optimizer? Did you stress test any of the inputs to see how robust it could be?
Yeah, so I'll take the question.
Slide 19, appendix 19.
Thank you. For our Monte Carlo analysis, we looked at four factors. Firstly, volatility in asset returns, geopolitical risk from stopping of exports, and then just logging returns from decline in commercial yield. And then the final risk that we considered was the fact that we would have to buy carbon credits if we fail to reach our net zero mandate by year 8. As you can see in the slide, even in the face of these external uncertainties, we achieved a median CAGR of 8.5% over the 10 years, with pretty good 95% confidence bands.
Yes, we could have one more question from the panel.
Perhaps you did share a few thoughts on the benefit of your operating model moving from outsourced partners to fully in-house, but I'd love to hear you on also the cost and the benefits of having an in-house team managing the overall portfolio for all asset classes as opposed to deliberately selecting certain asset classes for external mandates.
Yeah, I can take the latter part of it. So can you go to the slide 1 of the appendix? Yeah, so we did a cost benefit analysis of leveraging either like external managers for hiring for handling our fund, and also the cost benefit analysis of like having in-house management. So for in-house management, like the benefits were that there would be lower fees. They would take lower fees. We would have more control and transparency over our matrix and operations, and we can have tighter alignment with our own goals, particularly of like biodiversity in Finland. Whereas like costs were like it would like require significant investment, and also because we don't have enough technical knowledge about the whole biodiversity sector initially. So because of these like cons or costs, we opted for initially going towards external manager route, because that would give us access to like proven biodiversity indexes and like a lot of knowledge from experienced fund managers, and that would also help us to build our internal team and internal knowledge to gradually transition towards in-house management.
Amazing. Well, thank you so much, and let's give them a round of applause, please.